One of the things you learn early in this business of financial accounting is that what you initially thought was a simple and straightforward process can get complicated pretty quickly. Buying and selling, nothing difficult or confusing there, right? You buy equipment, you give up cash, you get some equipment, nothing hard about that. Same with a sale. Customer comes in, gives you some cash or a credit card, and you give them the product. A simple exchange, and you record the sale based on the price of the product, right? Well, sometimes that's the case, but not always. As we just saw with the folks at New England Boat Company, not all sales take place at a single point in time. Maybe that's true for a retail operation like a department store, but for many business-to-business transactions, the sales process takes a lot longer. First, the seller has to receive an order, maybe online or by phone. Then it may take several days or even weeks to complete and ship the order. That's certainly the case for our boat company. And even then, shipping can take some time before the product finally makes it to the customer. In these cases, we have to be very careful about what units we consider to be sold at any point in time, and therefore appropriate to include as sales in our income statement. The income statement is designed to cover a very specific period of time, a month, 3 months, a year, and can only include sales and expenses that took place during that time period. Do we report all the orders received during the period of sales, even if production doesn't take place during that period? Or should we include only those units that we've started to work on during the period? Or maybe just include the units we've completed and shipped during the period, or completed, shipped, and delivered. All of a sudden, there are lots of alternatives, lots of choices, and this is a pretty common scenario. As you think more about this, you also realize how significant the impact can be on your income statement, and consequently on how successful you'll look to your investors. You can arrive at a big number for sales by including all the orders you've received, regardless of whether or not you fulfilled those orders. On the other hand, you can end up with a much lower number for sales by only including those units that actually have been delivered to your customers. And if I'm the manager of the business, I'm naturally inclined to want to make the business look as strong as possible and to try to report the biggest number for sales and net income that I can. Of course, my investors and creditors want the income statement numbers to be as accurate and reliable as possible. They don't want their managers always reporting overly optimistic estimates of sales or net income. They want a clear line of sight into what's really happening inside the company. This is where the accounting standards, like US GAAP or IFRS, come into play, to provide guidance to managers when they have to exercise this kind of judgment. This week, we're going to look at several of the most common and important transactions that often require judgment on the part of managers, and show how the accounting standards can help us make reporting decisions that are both fair to the business and useful to our investors and creditors. Topics we'll cover include the basics of revenue recognition, inventory and cost of goods sold expense, and capitalization versus expensing. Understanding these concepts will give you the foundation you'll need to start to analyze financial statements and evaluate a firm's financial health, topics we'll address later in the course.